Well, extending the unpredictability of 2020, markets charted quite an aggressive course through the third quarter. So obviously, we had the sell-off in February and early March as COVID gathered momentum. A remarkably quick recovery in the second quarter, and then in the third quarter, the market just continued its ascent through through July and especially in August, with nearly a 10% increase in August, which was quite remarkable. And then all of a sudden, everything kind of rolled over on September 2nd for a couple of weeks. And after that September 2nd peak and the subsequent sell-off, we had a rebound into the end of the quarter. So, we sold off about 10% through September 23rd, and then just turned right around and started rising again. One of the things that continues to happen is that the index returns, specifically if you're looking at the S&P 500 index, the returns remained driven by the five largest companies by market capitalization, which of course are Apple, Microsoft, Amazon, Facebook, Alphabet, or Google, as it's more commonly known. Those five companies make up something like 22% of the index, and the price movement of those five companies alone influences the benchmark as much as the bottom 363 companies combined, which is really quite remarkable.
After a turbulent first half of the year, volatility in the bond markets during the third quarter was tepid. Treasury yields were largely flat. Investment-grade credit spreads fell slightly. In many ways, the first half of 2020 presented a perfect storm. At the beginning of the year, markets were at all-time highs. The global economy was blindsided by the COVID-19 pandemic. Then came the third quarter, and we really saw calmer seas prevail during this quarter. The Fed really began to take its foot off the gas, and populations around the world began to adjust to pandemic living. This gave bond markets, in many ways, a chance to take a breather and reassess the fundamentals.
The past year has seen a lot of movement in the fixed income markets. In the past quarter, the third quarter of this year, there's really been a change in investor sentiment. And this specifically is in reference to non-investment grade corporate bonds in the BB range. While investment grade corporate spreads continue to tighten, especially in the short end, BB spreads widened significantly over the past 3 months. The Sextant Bond Income Fund is well positioned for potential forthcoming volatility. And by this, we mean that the fund maintains a cash position of a little over 11%. And this is going to allow entry into potential price corrections during the election season.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate, so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting www.sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant funds in a free prospectus or summary prospectus, please visit www.sextantfunds.com or call 1-800-728-8762.